Ready.
Mhm. All right, you are ready to go, Peggy.
All right, great. Thank you very much. Hi, for all of you who don't know me, I'm Peggy Beauregard. Our company is the Nest Egg Builder. We work with people who would like to build their portfolio with real estate, get the deductions, and then we also talk about all the different aspects of how you could get tax deductions and introduce you to people that come on our show. Every week we have different speakers that will educate you about let's see, we have IRA companies that come on and talk about what they offer. We have CPAs come on. We have spendthrift trusts and living trusts and anything that deals with real estate. And then we also have people that come in and talk about mindset because people let their minds take them out. And today, from what I am told, syndication would be important because that's really where most of us invest. We're passive investors, or we are syndicators ourselves. And a syndication is a really simple definition: is anybody who's raising money for a real estate deal comes under SEC, and they do not have to register with SEC, but they do have to do certain things like put I'm trying to remember what a PPM is, private placement memorandum together, or use a special purpose vehicle. You could be a lender and that wouldn't require the same things. And there's also the accredited investor status. So there's lots of rules that go around it. And our job when we speak to you is to find out what your status is, where you want to go, how you want to get there, etc. But syndications, that's the big thing for real estate. And what we like to do, what I like to do in particular, is I like to be a limited partner in a syndication. So you could be a syndicator and be in single family 1 to 4, or you could be a syndicator and be in what you might consider a bigger deal, which would be could be a hotel, which is pretty big, or a resort. Could be we talked about different things: construction, theme parks, office buildings, mobile home parks, RV parks, industrial warehouse. My favorite, multifamily, which a lot of people seem to like. So all of those, if they qualify for a commercial loan, they're considered commercial. And things like mobile home parks, it's a little more challenging to get a commercial loan, but it still could happen. And a lot of times you could get the seller to carry back, which is even better if you know anything about that. So my understanding is there have been, and you're not the only ones this has happened to, this is happening a lot right now, is you're getting capital calls. So as an investor, one of the things when you're going to be a limited partner is you need to ask a lot of really important questions. I have a checklist, which I told Dana I would give you so you would get that. It's about 80 slots, check. And one of the questions in there is, what kind of loan do you have? You can't just ask anymore what kind of loan you have. So let's say Adapia's got an industrial building and she's gone to the bank and the bank's going to give her an 80% loan to value, and she has to raise the 20% equity, plus she's going to add some value, plus she has closing costs. So let's just say it's $1 million property and she needs to raise over $1 million, right? So she needs to raise that $800,000 loan, and then she needs to raise $21,000 or $22,000, $220,000 of equity to pay for the down payment, and then pay for any of the add value and pay for the reserves. Well, those are all questions you should be asking. Are you collecting for the reserves? Are you collecting for an add value? This is called capital. So the capital you're going to put in. Are you going to do, well, and I don't think I have this on the checklist. Are you going to do a cost segregation? Because a cost segregation splits out the property into different depreciation schedules so that you would actually be getting more of your money back. The cash flow would be higher. So it's just a lot of details like that. and I hope I'm not confusing you all, because I've been in the business for 40 years and I had to train myself around this. But the checklist is everything. You need to put yes or no what the checklist is. What's happened now is the adjustable rate mortgages have come back, because when the interest rates went up from the 1.96 to the 4.5, the syndicators felt they couldn't afford to pay a fixed rate mortgage anymore. And we've been watching over the years, all through COVID, we could see what was going on with all the spending that was going on by government, and the mortgages that weren't being paid, and all this expenditure that was out there, and people were cutting back because they had lost their jobs. Yes, but we could see that there was inflation there, and that the interest rates were going to go up. And we said for over 2 years, the interest rates are going to go up. The interest rates are going to go up. And the sponsors kept saying, no, they're not. No, they're not. I'm like, you've got to be paying attention. Well, they went up. What happened when they went up? They were in an adjustable rate mortgage of 4%. But here's what the problem on it was. When we were in adjustable rate mortgages back in the 90s, they only went up like an 1/8 or 1/4% at the most every 6 months. They're going up at 2.5 points now. That takes you from 4% to 6.5%. That's outrageous. I don't know why they're not using the LIBOR, or maybe they are, but that's what's created this capital call. That's one of the things that's created the capital call. If they can't pay that mortgage, they're going to go to foreclosure. And if they're going to go to foreclosure, all the investors are going to lose their money. So the reason they do the capital call is so that they can make the principal payment, the interest payment, and the principal payment. So you have to look at both of those. So that's one of the questions you ask right off the top. What kind of loan do you have, and what's the index on it if you're an adjustable rate mortgage? Anybody have any questions on any of this so far? Ask away.
I have tons and tons of questions.
Oh, good. I love
So,
questions.
For people who are investors who are new and don't know to ask those kinds of questions, and then let's say you're in media res with a situation that's playing itself out, right? Do you as an investor have any control anyway over how they choose to refinance? Like, let's say they decide, oh, we're going to try to refinance. You don't have any control over what they end up doing, do you?
Not usually. You need to read your PPM, your private placement memorandum, to see. A lot of times, if they're really experienced, they'll actually come back to the passive investors and ask them, if we do a refinance right now, we're going to pull capital, we're going to pay you back, and we're going to change the split. That might be one question. But do you have any say over it? No, I'm in a deal right now where the guy's always doing a refinance because he keeps saying he's getting a lower interest rate, so he never pulls capital. But yeah, we don't even know that they're doing it until after they do it.
So if someone was irresponsible and took an arm, like I took a variable loan,
Yep, unarmed.
irresponsibly, and now they're creating a big poop pile because of their own actions, is there any recourse to investors?
You would have to get an attorney involved in that. It should be in the PPM about what kind of loan they were taking. So really, for our responsibility going in as an investor, if I were to look at it, this is just me. If I looked at something and somebody said they were going into an arm, I would run. I never would go into anything but a fixed rate. And some of the deals I'm in, they have a fixed rate, but they're in interest only for 5 years. And then the principal kicks in after the end of 5 years. So they're actually in a 25 or 30-year loan fixed, but they're only paying interest for the first year, 2, 3, 5, whatever. But they have to be in a position. And the real question is, at the end of 5 years, are you in a position where I'm still going to get my 8% return and you're still going to be able to make the principal, interest, taxes, and insurance payment monthly? So it's our job to protect ourselves from them, because a lot of times they're just looking for the money and they're not thinking all the way through. If you're working with somebody that's older, let's say somebody that's done quite a few deals, 8, 10, 15 deals, somebody that's a little bit older, that they're in their 40s or 50s or even older than that, they look at all of that. They are all about protecting the investor. These younger people, they just think they can do it. They don't, I'm sorry, I don't think that they listen. I used to be on a show where I was a shark, and you tell them the interest rates are going up and they boo-hoo you. Like, well, you're not getting my money. If you're not going to listen to me, and I've been in the business for 40 years and you're going to tell me that's not going to happen, you have no clue what you're doing. And again, it's our job as passive investors to be paying attention to what's going on in the economy, because we're in a weird economy right now. You know, we've never been through COVID. COVID was crazy. And I'm in California, and some of you are in California. California shut us down. There were places that didn't shut down at all. And people would boo-hoo those other states. But guess what? Those states survived and came through, where California is going to take them quite a bit of time to fully recover. And then there's other places that will take time to fully recover. And that's going to take time for offices to fully recover. People don't think that'll ever happen, but I happen to think it will happen. I'd bet on it. Because every time we come through one of these, something new completely happens. We're in, I mean, technology's been around for well over 100 years, but every time we come through one of these down cycles into an up cycle, and now we're in a down cycle, all kinds of things happen. People lost their jobs. What do you think they're doing? Sitting on their thumbs? No, they're now entrepreneurs. They're out there looking at real estate and getting involved in real estate. They're out there learning, they're educating themselves. They're not letting anything stop them. And then there's the rest of the world, right, that lets everything stop them. So, and you guys are not people that are going to let anybody stop you. Any more questions, Jennifer? You said you had a lot. Sorry, I went on about that. I'll try to keep it shorter.
No, I mean, I have lots of questions, but I don't want to hog it. I'm sure others have questions too.
So here's another thing to look at. You didn't ask this question, but cap rates. So a cap rate, that's like an interest rate. They don't call it cap rates anymore, but they always close on a cap rate. Then they say they're going to pay you a cash on cash. You want to know what that cap rate is that they're closing on, and then you want to know what they're paying you against that cap rate. But here's the really important thing. When they say they're going to sell in 5 years and they show a cap rate that's lower than what they paid, that's not going to happen. We're not in that world anymore. Right now, cap rate should be 2 to 2.5% above the fixed rate, the bond market. So right now, cap rate, interest rates are at 7.5. We should be getting 10. We should be getting 10, 9.5 to 10 cap rates, cash flow. And we're not. And they're saying, oh, no. And if you look at how they put the deals together, I'm like, how are they going to make that work? They're going to make that work by not paying themselves. Well, I don't like that. I want them to pay themselves. They should put the deal together so they're making their profit going in. So.
Well, that's one question I do have is, it seems to me that in some of these deals, they can still pay themselves no matter what's going on, and that they can pay themselves first and count that as costs of the deal. Is that true?
Yeah, they call it a acquisition fee. And I saw one the other day that was 3%. I'm like, wait a second, you guys aren't putting any money in, and then you're taking 3% from the investors? I don't like that. We're out. That nobody did that, by the way, in the before 2000, 2005, actually. Dave Lindell started telling everybody they should start taking an acquisition fee. So everybody started taking them. Up until then, no one took an acquisition fee because they were getting 20% of the deal or 30% of the deal. So why, this is just me, why does a GP get to take an acquisition fee and then get 30% of the deal? I don't get that. If they put the deal together right and didn't take the acquisition fee, you'd see a whole different structure. Just saying. Well, this is what we've got. We have to deal with what we've got. If we want to have our money invested in real estate, we just have to work with the right people.
I have a question too then. Sorry, guys. Don't make me be the one asking all the questions. Have the questions, but please talk over me. I don't mean to stop people from asking. So I think, Peggy, you participate in deals. Do you get investors to invest with you when you go into deals?
Well, they're not my deals.
Uh-huh.
I work with syndicators. So somebody has a family, a multifamily, they'll send it to me. Industrial. I've been working with somebody that's got medical that they've been sending me. There's a lot of construction going on right now. So different syndicators send me their deals and I look them over and then I send them out. We have about 1,000 people that are in our CRM and we put the deal together so that it's understandable. They send their deck to me. I vet out. I use that checklist that I have. I vet it out. And if it looks like it's a good deal and we talk to them and get all our questions answered, then I'll send it out to all of our people. We have about 200 active investors right now. And if they like the deal, then we introduce them to the sponsors because that's who they're investing with. They're not investing with us. We're just the go-between, the matchmaker. And then they invest with them. And if they like the next deal, then they'll invest with them. We have people that have they like the people because they're upfront about everything. And if there's a problem, they send it out right away and let them know there's a problem, if there is one. Otherwise, these people get their checks every month or every quarter.
Well, I don't mean to put you on the spot, but I have a question about
Put me on the spot.
How do you monetize your role there then?
The sponsor pays us a fee. We are not part of the GP team. We don't want to be part of the GP team. We want to be hands distance, arm's length from what they're doing because we want to look at it like we're going to invest our money in it and not have anything saying, oh, I'll get part of this deal, so I'll just bring people in. No, that's not us. We won't do that. That's not good enough for me. It's not good enough for you. And I look at every deal that I'm putting my money into it. And most of the deals, if I have the money, will go into it. If I'm not going to put my money into it, you guys aren't going to see it.
Mm-hmm.
And there's quite a few you don't see. Well, you guys don't see them anyway, but.
So it seems like we would be able to rely on you as a resource anytime we have other investment deals in front of us because I mean, I don't know. I don't want to abuse your knowledge and expertise, but to have 40 years of experience and to understand the terms of these deals at the granular level like you do is really helpful because I can't see myself taking the time to become versed enough in the nuances of these deals. I don't have the headspace for it. I'm busy with other things. Like I know that we have friends outside of WOW even that like look at deals still now, even as things are depreciated. Like how would that work if they're looking at deals and we know you? Are you able to put eyes on it or how does that work?
Well, if you have something you want me to check out for you that you want to invest in, I'll look at it for you. If you want to refer somebody over to us for us to raise money and you're thinking about going in, it's a whole nother discussion. We talk to a lot of syndicators. I'm supposed to have like 9 or 10 deals flowing our way this week, but they haven't all come. One guy actually was doing so well. He had 5 deals and he sold 3 of them without ever, that's how good the deals were. Somebody came and found the deals and said, I want to buy them, and they bought them. So now he's down to 2 or 3 deals. He's betting out some new deals, but we just got one from him. But it's construction, and you've got to know enough about construction construction's highly volatile. It's, yeah.
Hey, Peggy, sorry to interrupt. Dr. Victoria actually has a question.
Yep, she does.
Awesome.
Victoria,
Peggy.
Dr. Victoria.
Hi, Peggy. Thanks so much for your time. I tuned in, I think, about 4 minutes late, so forgive me if you've answered what I'm about to ask. I heard you say at the tail end that the deals that you're like if you saw a deal with variable rate mortgage, you would run from that. And I'm about just 3 years into syndication multifamily investing. And so when I sort of was introduced to different syndicators, they were all into variable rate mortgages. There isn't a single deal I'm into, maybe one deal out of a dozen that didn't have an expired variable rate mortgage. And several of them are in capital calls distress right now.
And that's right.
And it's gut wrenching. So a couple of questions. So number one, when you're faced with the issue of the capital call, how do you know, or I mean, it may be a rhetorical question, but it feels like sending good money after bad. However, you're sort of desperate, like it's your baby. You don't want to see it fall away. Like, you want to do anything you can to save the deal, except for be stupid and just send them more money. And so that's part one. Part two is, I've been thinking maybe the only way out of this apocalyptic situation is to be the people on the other side of the buying of the shitty deals that I'm in. Be with the syndicators that are buying at a discounted rate the shitty deals that I'm in at the full price, So are you aware? I'm sort of like shy about certain syndicators now. Now I don't know who to trust. I mean, of course, now I understand the simple question about the simple versus the variable rate. That's simple, but it's also highly operator dependent. You could be a shitty operator and screw up a good deal, and you can be a crappy, a better operator and save maybe a struggling deal. So I know that's two questions, but I'll let you answer. Thank you.
Okay, so capital call, like I got a capital call the other day, I got a detailed message as to what the money was for. So I don't know whether you got that breakdown or not. Did you?
Saying the money is to purchase another fixed, a cap rate. The money they're saying is to purchase the rate for another year from the bank, but it's only for 1 year.
Are you talking about a rate buy down?
That's right. Only for a year, because they had purchased rate caps, but only for 2 years. And the rate caps expired. So then they're trying to buy them again year at a time, but they're super expensive, like $1 million for one deal.
Yeah, so wouldn't you like to be that bank?
Yeah, I would. But I'm stuck with my money in this shitty deal that seems to be dying, and I don't know what to do.
I don't know if I can tell you what to deal. Yeah, so they
No, I
want it for the
That's
points.
not telling you what the deal is, because I wouldn't expect,
But there's no cash flow.
there's no cash flow. No, not at all.
And they're using the cash flow to pay all the expenses on the property.
Right.
And pay the principal on the mortgage.
Yeah.
Because they didn't make that plan.
Right. I know. I mean,
$1 that seems outrageous.
I wouldn't have gone into that deal, if I could rewind time.
Yeah.
But what when you're already in the deal?
Yeah, well, the capital call, here's what happens. They do a capital call, and if you put money in, it doesn't dilute your share. If you don't put money in, they have to go outside and find more people that'll put money in, and then that dilutes your share. So there's
I don't really
side of it.
Diluted share at all. I just want to get my money back. I don't even care at this point if I get any interest. I just want to get 99.9% of my original investment.
Have you brought that up to them about doing a refinance and pulling? I don't know that they qualify to pull cash.
No, they don't. No, they're in distress. They're in distress. It's a distressing situation. I know I think I'm not the only person. I may be the only person on this call. But yeah,
Yeah, you're definitely not the only person. We know other people that are going through this for sure. And we're really helpful to you. I mean, we're grateful to you, Peggy, because these are real life, real time questions also.
Yeah, and I don't know what to tell you because I would never go into an adjustable rate mortgage. You know, I've been around, right? When my husband and I were going to buy our first house, the interest rates were at 22%. You only ever went to your bank to get a mortgage, and then you always worked with your bank. Well, the rates were outrageous. That's when they came up with this adjustable rate mortgage, and the index of how it adjusted. So we bought the house we were looking at, and we assumed the VA loan and had to borrow from everybody we knew to pay the down payment because the seller wouldn't carry a second. So that was our very first experience with real estate. And me, I didn't know, I was clueless at that time too, but we were not. And then anytime a adjustable rate mortgage was offered, we always looked at, well, what could happen? What's the worst thing that could happen? Because the syndicators never talk about what the worst thing is. They always try to make it glossy and how pretty it'll be. But my question to anyone is, how much is it going to adjust? Because it's adjusting at like 2.5. How often is it going to adjust? Is it going to adjust every 6 months? Is it going to adjust every year? Is it going to adjust every 3 months? What's the adjustment? And if it goes up 2.5 every adjustment, what happens next time it adjusts? Right? That's crazy. Oh, and the banks, boy, they are gonna, yeah. Oh, this is maddening. And yes, you're right. There's all kinds of people, Dr. Victoria, that are sitting in the wings waiting for these properties to go down, because they're going to come in. They're either going to buy the note from the bank or they're going to buy the property at the discount. And they've been sitting there waiting for years because they knew this was going to happen. And they knew it was going to happen. So how could all these people go into adjustable rate mortgages? Who were they talking to? Sorry.
yeah, I'm those people. Yeah, I'm totally those people. So yeah. So on that note, thank you for that honest answer. But the truth is the truth. The truth is the truth. So that's just how it is. So the question,
how much do they want?
Some of them want like 20% of the original capital. Some of them want 30% of the original capital. Some of them want 15%. It's different deals.
And are each one of them on a 1 year, or are they each on different years?
When you mean the rate cap?
Yeah,
1 year.
you said they're buying down, and they're all buying down 1 year.
Year at a time.
And they can't do a refinance because they're not in a position that they have equity anymore.
Right.
Well, I think these were middlemen, some of them. They are middlemen themselves, right?
Well, I'm
They don't-
talking about, one example would be Tides. Another one is Tryon. I'm talking about those two syndicators right now. There's many. So
well, isn't there net operating? Don't forget the mortgage is a part of the NOI, net operating income. So if they had a 20% or 25% when they closed, why wouldn't they have a higher equity now? The principal did not go up on the property. So it should actually be higher, because haven't they raised the rents?
well, their letter says that the rents are not keeping pace with the mortgage, with the interest rates being higher. With the payment, with the debt service, with the interest rates being higher. Yeah. I think the deal with those where they were thinking they would fix and flip. They were thinking they would fix it up, raise the rents on portions of the property, and then resell before the rate cap. And, that's it. That's what I think their whole model was. And
yeah, how many deals have they done?
well, how many deals have they gone full cycle? They had gone full cycle in a few deals, but this particular syndicator was rather new. Other syndicators have been around for a long time, and I don't know what I was thinking. And they also had acquisition fees. So you live and learn.
I'll do. I don't see anybody that doesn't have acquisition fees now. I don't
Yeah.
like acquisition fees. I think that they're incorrect and they take that money from the investor rather than giving them a better return. But that's just my own opinion because they weren't around when I was doing this. We never took an acquisition fee ever. We got our 20%.
That's awesome.
I have a question.
Yeah, Jennifer.
It looks like I'm seeing in the news a bit of a crackdown on just the real estate sector generally. Like we just had that big lawsuit with actually Warren Buffett's real estate holdings, and a few others were implicated in conspiracy to raise real estate realtor fees. I guess that, I don't know if you saw that article, but it was just announced. And there's a big crackdown, and they think it's going to change the real estate industry because realtors have been making a lot of double dip commissions for a long time too. It used to be realtor fees could be like 3%, and then they kind of all suddenly all became 5% for both buyer and seller. And it was like
10%.
Yeah. So that apparently there was a big class action lawsuit, and then they hoped to appeal, but they didn't win. Like the class action lawsuit won. And if that sticks, I think there's going to be just in general a bit of a shakedown on the real estate sector to sort of be like, there's been a lot of violating of the piggy rule, which is like, you're taking a lot more than you're actually giving in certain places. Like you're taking on as a sector, the real estate sector is taking an awful lot, making a lot of the players in the industry quite wealthy, but at the expense of the people who are either investing or sharing and selling properties. Do you think with that crackdown and with what we're seeing with so many of these other syndicates having such a bad track record, there's a chance of a class action lawsuit that could help investors like Victoria?
You got to read the PPM. That's what's set. Unless there's a loophole or something in there where they violated or created fraud. Ignorance is not, you can't win on ignorance. You can only win on fraud.
Yeah, commission percentages aren't, they're not restricted. So
no, but they're negotiable. So
they're all negotiable. Yeah.
Right. So if somebody comes to you and says, oh, it's 5% for this and 5% for that, you go, nope, I'm not paying that. I'm not going to pay that. So they can try to sue Warren Buffett, but the law, as I know in California, which I think applies to almost every other state, is real estate commissions for the buyer and the seller are negotiable. And we have seen people go into escrow and say, I'm not paying any commission, and the escrow officers will stop any payment on a commission, which we think that should be illegal, right? Because you did all that work and you didn't get anything because somebody got mad at somebody. So there's all sides of it. But yeah, if agents are doing that and people sign it, what are they going to do? Here's the problem. There's a group of people that will take advantage of others, kick them when they're down, right? They don't know that their fee is negotiable. So they just hand them the paper and tell them to sign it. And we'll say the seller listing signs it, not realizing that they could have said, hey, I'm not going to pay this. Your fee is negotiable. And I will negotiate it down from 10% to 4%.
Well, that happened
both sides.
I experienced that when I looked at the fine print and I was like, wait, why is there 5% and also 5% on the seller? Like, what's this all about? It was when I was getting ready I thought I wanted to sell my house. This was like 2-3 years ago. And I had to sign the contract with the realtor before we sold the house. And luckily the house ended up not selling, which has been a huge savings grace. But at the time I was like, what the F? 5%, like 3% is okay, but 5%. And I was told that's what it is nowadays. Take it or leave it. And I think when you don't know, just like a lot of us are trying to grow and flex our wings, and luckily we're all doing that at a young enough age that we have 40 years in front of us, touch wood, or 30 years in front of us to grow and learn and iterate and improve, right? But when you don't know that you can push back at all, or you can be like, well, then I'll work with a different realtor. Thanks. Goodbye. Like coming from a place of, oh, like as if I'm so desperate that I have to work with this. Like we don't know until we know. And after we do know, then we can be a lot different in the negotiation. So this is very valuable to just have. I know it's painful too, learning so much, but sometimes these really painful experiences grow us in ways that the fun and good experiences
Hey, don't think I haven't had some painful. I lost $500,000. I can tell you it's really painful.
Tell us, it'll help a lot of us feel better. Please tell us more.
Oh, about my loss?
Yeah, and how you came back from it.
Oh, well, because I just pulled my bootstraps up. So someone brought to me this old historical building outside of Atlanta. And I had a dream. Me and Martin Luther King, we had dreams. I had a dream. I wanted to take this beautiful 2-story building and turn it into mixed use with a dance floor and restaurants coming in and then having living spaces above it. And I just thought this was beautiful. And I had some 1031 money. So I used my 1031 money to close on it. And the city said, we're going to support you through this. So, right, I closed. The city said, well, not really. I'm like, what do you mean? You guys said that you were going to support me in this, and I need a loan so that I could start the project. And I went to an architect. It cost me another $76,000. I only remember it because I came across that invoice the other day when I'm cleaning up. $76,000 for architectural fees. I paid 130, no, more than that. I think it was more than that, plus all my other expenses. So it was over 200,000. No, I know it was closer to 500 by the time I got done with everything. Because I had to apply for. So what happened was I ended up donating the property back to the city. So I donated the property back to the city because I couldn't get any money to do the construction. So I applied for all the construction. I had to put all the applications in, pay for all of that. And then one bank would say, no, go to this bank. And I go to that bank. And I spent 2 years trying to get that loan in place. This is
what Peggy, you can come to me.
Yeah, well, they didn't want, I don't know. Anyway.
I'm a private construction lender. That's why I say that.
Oh, good. Oh, well, you and I should talk because I have lots of people that are looking for money right now.
Yeah.
So I donated it back, and then the city had the gall to turn around and ask me if I would donate my architectural. I'm like, you could pay me the 76,000 for it and I'll give them to you, but I'm not donating those to you also. After all I went through, and they said they would support me, and that's the only reason I actually ended up closing. They lied. So
Oh my God.
what did I do?
Peggy, what year was it?
That was back in 2007. You know, because we were in a down cycle at that time. That particular area was in a down cycle. They really weren't expanding, but they said that this is something they really wanted and really needed. And they actually only had one vacancy in all of town in the commercial world. So it didn't look like there was any reason why you couldn't move forward with it. So it was a lesson I learned.
Did you at least get a tax write-off for the donation?
Yeah,
Yeah,
I got that. Still, that didn't bring me any money.
no, of course, but you were at least able to capture.
That's the only, right.
Benefit.
So I did do that. I got that. But my lesson was, don't leave my core. My core is not taking a property that I have a dream about and turning it into something that fits my dream when that's not what my experience is. And I brought people in to support me through that and do all the things. And they're like, oh yeah, this looks good. Everything looks great. I mean, but my core is what I'm doing now, investing in real estate, showing other people ways to build their portfolio. So I made up for that because I was in another deal and we did 100% on that deal. And so I made up for that. And now that's all I do. I don't go out anymore. Now I'm just a passive investor. I'm not going to go out and knock on doors. It's too much work anyway. All these other people are doing it. Let them do it. But my checklist, to me, that's my golden egg. I'm not, if somebody's in an adjustable rate mortgage, I'm out. If they're taking a high acquisition fee, I'm out. I mean, 3%, I thought 2% was pretty outrageous on a $28 million deal. Do you know what that is? That's huge. Huge. Let them take it on their profit side. Anyway, sorry, I know. I hate it when people lose money in this business. There's still people that don't know what they're doing. And I don't know what to do for you guys. I'm sorry. I feel terrible.
Well, Peggy, over the last like 10 years, I've noticed too on the sponsor syndicator side, if you will, that they started to get more and more egregious in the fees that they were taking. So not only the acquisition fees, but you would see a lot of fees, like they would just get slotted in everywhere. And then, and then their hurdle rates changed. So what might have started in 70-30 would go to, or I'm sorry, from like 80-20 would go to 70-30. And then I saw things like 50-50 over an 8. So,
Yep.
They just started to get, as things ramped up, right? Because it's the cycle of buyers and a seller's market, just like in residential. Because when you're on the other side and you have no negotiating power, you have to sort of take what you're given. That's what happened with the run up in residential prices over the past couple of years, where you would get 15 minutes to tour a house and you would have to put in an offer, you and 20 other people, right? And so in a similar but not as extreme fashion, especially on the multifamily side over the past 5 or 6 years, especially, you would just see this just egregious fees, just sponsors taking huge amounts of fees, doing nothing differently, but because they could. And that's always really hard when you're in a market and you don't have that negotiating power. You can, of course, walk away. There are plenty of syndicators, but I did notice because I've been in this space for a decade, I did notice that was happening a lot. And there were very few that weren't taking advantage, so to speak.
Yes. And it's up to us as the people who are going to go in and partner and tell them, look, we're not coming in because you're taking a huge acquisition fee when you're already getting 50-50. I mean, I do work with somebody, they never take an acquisition fee and they take 50-50. And they still pay you a 10% return. So do you care that they got 50% of the equity when you're getting your 10%? Not really. You would be getting possibly a higher, but they do a straight cap rate. They do a straight return to you. So they're good. They own about $750 million properties right now.
Yeah, I mean, I think you're really wanting to look and compare different pricing structures and return structures, and then overall strategy, like what every operator or sponsor is doing, as a strategy.
Yeah, do they have one? They all seem that they could go in and raise prices. I mean, I looked at one deal and they said, we're going to raise the rents $500. I said, there's no way you can raise the rents $500. We'll do that over the years. I said, that's not what your deck says. Your deck says you're going to raise $500. Doesn't say we're going to raise $500 over the next 10 years. So why would somebody come in and, I mean, that's enough to scare everybody away. So we don't raise any funds for them because that and the acquisition fee. You've got to be very clear in your deck.
Yeah.
because that's what you all depend on. And the other thing I notice is a lot of syndicators never put in their T12 or their actual income and expenses that they get from the seller. They just put in a pro forma. Well, how do you know that pro forma is going to work if you don't know what the real income and expenses are? You don't have anything to compare it with. And I'm just shocked at how many people actually invest based on the pro forma, the dream. And then again, what's the cap rate going to be in 5 years, which will be 2028? What are the cap rates going to be? Because what are the interest rates are going to be? We came down for 40 years from 22 to 1.96 over a 40-year period. Now we're on the way back up. I never understood why it ever left 5%, frankly. Every escrow I looked at my parents did was always 5% mortgage. So why did that have to change? I don't know. Jennifer.
I have a question. Let's say you're in a deal and it hasn't had a capital raise yet or anything. And you're feeling like, okay, but you're holding your breath because you don't really know where things are going. You're not allowed to go and say like, hey, I want out, right? They can't just like return your principal and cut you out, can they?
There should be something in the PPM as to whether you could get out or not, and what it is that you would have to go through to get out. It could be in there, and it could just say you can't get out, which most of them do say, but look for it in your PPM to see what it says. Dr. Victoria, that would be a good thing for you to do in yours. And yeah.
I mean, just to be honest, I don't really see that as an option. The deal is failing. Everyone wants out. Everyone wants their money. If everyone pulls their money, that's the same as no one contributing to the cap call. The deal dies anyway. So it sounds wonderful, but not realistic.
So the thing is, how do you force the GP team to sell? Because that's what you really want. You want to sell and get your money back.
Well, right now, if they sell, it would be at a loss, so I wouldn't be getting my money back.
At all?
That's what they're saying. Exactly what they're saying.
Are they sending you the financials? Are you getting quarterly updates?
Yes, they are sending them. How they did the math on figuring out that we would lose. I'll just give you an example. One of the capital calls I have say, if you contribute to our capital call, you will only lose 20% of your investment. If you don't contribute to our capital call, you will lose 100% of your investment. So that's my choice. Lose it all or lose 20% or lose some amount of that. So there's no iteration where I get my money back. So
get the financials. Yeah. They should have sent you all the financials and shown you where that money, what's not covered on that. You should see all the income and all the expenses. Ask for the rent roll. The rent roll show you who's given notice to leave.
I'm sure these guys are paying themselves. I'm sure they've taken their money. Like I just feel like
management fee.
What?
They're taking their management fee.
They already took their money off the management fee, the acquisition fee, all of that. It
sounds like the pro formas have all been written in a way that's really way too favorable to but that was happening as a trend. I wouldn't be surprised. I'd be really surprised if there's not more regulation. And that was my question. Is there any kind of regulation over this industry?
Well, that's what SEC is saying, that they regulate. And if you come to them and ask them to investigate, they'll investigate. I've seen them do it.
There's a difference between like a management fee. I mean, somebody has to collect the rents and somebody actually has to do work. And that's a valid, I think, expense versus the asset management fee that if they're taking money and everyone else is losing, that's not a good look. So you have to kind of really define what the difference of the management fees are, because there are fees that you have to pay to operate the property.
Sure. And you have an on-site manager that has to get paid.
Yeah.
But are they taking an acquisition fee? I mean, are they taking the asset fee also? when in a time like this?
Because I bet they are, because this is how they make their money. They don't have
Yeah,
jobs
yeah,
otherwise.
right.
They're
don't
not
keep-
all, some of them are deferring it. They're not all,
they?
because there is no money for anybody other than keeping the people on staff to run the buildings.
Which they have
So
to
there
do.
are groups that are deferring or choosing not to. There are a lot of groups that are doing lender workouts. So they're working with the lender so as not to completely lose the building or the buildings. So it just depends on the group, and it depends who raised capital. So everybody's different. Everybody's doing very different things. It's not across the board that, you know, like a lot of people made mistakes, but it's not like everybody that is issuing capital calls is somehow a bad actor. Like, I really want to be clear about this. This
I
is
agree with
not the
that.
case, like
No.
at all.
Yeah.
Like, I mean, I think it's a little unfair to characterize it that way, because the strategies on variable rate 2-year loans were fix and flips, and a lot of these groups did very well. They returned 100%. In
Right.
12 to 15 months, over and over and over and over again for years. So, you know, they found themselves in a Fed rate run up that wasn't expected in how fast those rates came up. And so that was the catch with the variable rates, is that in a way it was like bad timing. So those groups have to readjust strategically to go from being flippers to basically holding on to a building for X number of years. And if they weren't built for that strategically, because you need a certain type of staff in place and property managers in place, and like it's like a totally different type of business, they've had to like readjust, which takes time. So and then there are groups that were, you know, totally unprepared, entirely didn't even think about it, were like yahoos about it, maybe didn't even have rate caps in place at all. And that was just taking on far too much risk at the time. So it's variable in terms of where everybody's at with what they did. But I want to be clear that this is not a case of a bunch of bad actors that came in and did anything, because I think that would be really unfair to an industry that has returned a lot of money to a lot of people.
Well, I get what you're saying, and I wasn't saying, I think there's so much nuance, and I think that's the point of this, because, you know, Victoria deals with like 4 or 5 different people, I think, and I don't think they're all created equal. And I think the problem is, as an industry, okay, it doesn't seem to me like the real estate industry is regulated. Look, I'm in an insurance industry. People love to blanket that with like, oh, it's all terrible, and yet it has more guarantees and requirements and all the things and anything else, and it gets shat on all the time. And real estate is somehow king and beautiful and perfect, and yet you look and then you find out that because of the way it's set up, it's absolutely possible that on some of these deals with Victoria's deals that they've paid themselves. And if you don't know how to even find out or ask, you don't know. They're all the same. But I think knowing that that can even be a possibility is half the battle. It's the same with insurance products. If you don't know that variable is different from universal, and you don't know that certain fees inside are different from others, you don't know, and then you can easily get hit. I think it's just really important to understand that's even a possibility, that on some of these deals, these guys are still paying their own mortgages, still, you know, going on vacations and taking their fees, and that it's Victoria's right to find out and ask. I didn't even know that's a possibility. I had no clue. I've never done real estate. So I'm not trying to say that this entire industry is awful and it's filled with bad actors. Absolutely not at all. Please know that that's not, it's just that for me, I'm learning how important it is to look with granular detail at the details in order to try to stay safe. And that's so true everywhere, it looks like, in so many of these different sectors, but we don't get taught that.
Yeah,
That's
no,
true.
I think you're completely correct about all of that. And so like the insurance is a really good example, because people are out there selling things that you're like, hey, hold on, that's a really bad idea, because it's different from all these things, is like getting in the granularity. I just wanted to be clear for people watching after and everything, is that this is just like the insurance industry. It's not all bad actors. It's also not all bad actors. And like having somebody like Peggy, or even me to a degree, or Christina, or people who work at different places inside of the real estate investment industry, is like, you don't even know what questions to ask. So like ask us what questions to ask and like go about it. I just really wanted to be clear that there's also a lot of really good people out there doing their best, and also ones that came into a bad situation. I'm in a deal with a capital call. It has nothing to do with interest rates. It has everything to do with insurance, actually, because the insurance went up 100% or 3x, like it tripled, like something insane in Florida on like a great business plan on really unfortunate situation. And so, you know, you have these situations where that happens. And I think a really important thing, and Peggy, I think after your 40 years of being in this, is like cyclically, next time we come into a cycle, because there's going to be another exuberant cycle at some point, we'll know how to recognize at this time and say, you know what, I learned my lesson on, you know, variable rate. I'm going to stay in this like fixed rate over here, not as sexy. And that's okay, because sometimes we all get lost in this idea of like these big numbers, but we really aren't understanding how risky those big numbers can be. And I think that's also human nature.
Yes. I just want to echo real quick on the lending side. I have great sponsors that do syndication, that have great projects, A++ sophistication, and they're underwater in their projects. And it's only because of the interest rate market right now. They can't refi out without a huge equity pay down. So just to echo what Adipia was saying, that there are some good players out there that are just getting hit right now because the multifamily market as a whole is struggling.
Right. So anybody doing that now has to, like the one I just looked at, they just figured the interest rate was going to be at 10.5% for their construction like that. But for Victoria, I would suggest that you get the income and expenses on all the properties that have asked for a capital raise. They should be giving that to you. They can't just say, oh, you got to put in, you know, $20,000. They've got to prove to you it. If they're not proving it to you, then that I would question them, because you want to see, are they getting their fees, and is there not enough capital? So here's what I would do. I don't know if you know how to tell the value of a property or not. So the value of a property is you take what's called the net operating income. So it's the net income minus the expenses. And you take that and you divide that into what am I doing? Oh, how much do you think the property's worth? No, you want to, and you divide the price of the property. Let's say what you paid for it, or what the equity and the value of the property is right now, and divide that into your NOI, and that'll tell you what your price is. I did it backwards. You divide your cap rate, which is 0 right now, right, into the NOI. So you have to fiddle with that price. You want to find out what the price is. What you want to find out is, do you have more value in the property than you do loan? And how much equity was put in? So you can see. So if you took what the loan is plus the equity, what all the investors put in, that's what your price would be. And if you divided that into your NOI, that would tell you whether you've got a profit there or not, or break even. Because that's
on a lot of these properties, what Victoria's talking about, it's not. They would sell at a loss because the cap rate is so low. Like,
right.
There's
2%.
not enough. There's not enough NOI, because a lot of them were value add. Like the reason that they were on variable rate is they were value add. So they needed to put in the construction dollars to be able to raise the rents at, you know, higher than average rates. So these are like class B, class C buildings that and for the most part, right, I don't know every single operator, but the ones that I've seen. And so in certain markets, because of COVID too, there was a lot of fraud on rent, especially the Las Vegas market. There was a ton of fraud on rent. So you had people essentially not paying their rents, number one. They had to stop construction, so they couldn't raise the rents to where they wanted to. Number two, and so then you had to go through eviction processes, which brought down lease up. So there, in some markets, just a lot of things kind of conspired in the worst possible ways I mean, you've got occupancy down, you've got lease down. And so that's the problem, is the money, you know, the money's not there. And if there were no rate cap, then obviously that's just a disaster because the interest cost is so high.
Right.
And some of them had rate caps, they did, but those rate caps expired because of what happened over the past year and a half. So where these properties were supposed to sell, let's say this year or last year, they couldn't sell because of what was going on in the market. So it's a variety of things that have brought it to this place. And so some operators are saying, if we could stabilize the asset, we can hold through, finish renovations, let's say, and hold on for a while longer, because if you hold on to a building for long enough, and if you can stabilize it, the market does go back up. We don't know when, but generally speaking, that's the thesis. Super high level, like generally speaking. And they can't go into a fixed rate because they don't have the equity to be able to go into a fixed rate. And in any case, they want to still sell it in 2 to 3 years. So everybody's doing different strategies, and different
Right.
lenders are doing
Which is-
different workouts to try to help. It's been actually pretty crazy to see how many lenders are being helpful because they don't want to take the property back. Yeah.
So why don't they just reduce the rate?
Well, they'll never do that. I mean, I don't think that's in their business model,
They'll
you
never
know,
do
but
that.
they're waiving fees. They're doing, I've even seen in cases where they're letting people buy a 6-month rate cap and then the next one in 6 months, because the expectation is rates are going down. And so that'll be cheaper in 6 months than buying a full year right now. And so there's different, they are reducing fees in some cases, but I don't think it's in a lender's business plan to reduce their profit margin by reducing their rates.
Oh, probably not at a PIA, probably not.
So it's a good time to be a lender right now. And that it swings. It wasn't for, you know, before, like people were like, poo, I don't want a 6% coupon when I can make 20% equity. So it's also what investors wanted.
Yeah, I'm just wondering if they raise the capital to fix up the properties, and then did they fix up the properties and then they just couldn't get the rent, or did they not fix up the properties and now they're using that capital to pay the principal, pay the higher rate?
Oh,
But
I
we-
don't know. I
we
mean, yeah, we have to look at the
Still,
financials.
we should, when somebody gives you a capital call, they should send you all the financials. You have a right to see everything,
Absolutely.
right? Because maybe you have an idea that could be helpful and they could do it in a different way.
Mhm.
Bring in another investor, for instance. Like things
Now,
like,
Peggy, do you work with every type of investor?
meaning, I don't
Like
know.
who can invest with you? Do you have to have a certain minimum? Like, how do you, like, if
Oh.
anybody here was saying, hey, like, I really want to entrust my choices in real estate to Peggy, like, how would somebody work with you? Or do you only work with family offices? Like, how do you work? We want to be able to give you an opportunity to tell us a little bit about yourself like that too.
Oh, thank you. That's really nice. You know, we work with most people who have like a 401k, a self-directed IRA. It's really the whole purpose of us even starting this business was to see if we could help the middle class step up and build a portfolio, maybe be able to do something for a class below that to get them be able to actually have a decent life and not have to be hand to mouth for every paycheck. You have to start somewhere. And most of everybody that invests has a self-directed IRA, and most of the minimums are either 50,000 or 100,000, depending. And we do have some that are 250,000 or a 500,000, but those are more rare or rarer, whichever is correct English. So we work with almost everybody. If you've got an old 401k, you could roll that into a self-directed IRA. If you've got a current 401k, you can't. And then we like to educate and make sure you've got the right support team. You're working through us, if that makes sense, right? We're the catalyst to where the deals are. So we work with about 15 or 20 different syndicators around the United States in all the different asset classes. And I know it sounds like you all are pretty much in multifamily. We're not a big fan of multifamily. And the only reason is because the expenses are so high on multifamily, where they're so low on almost every other aspect of commercial. RV parks pretty much have a little bit higher because you have to have somebody on site all the time because it's more like a job. But, mobile home parks or some of the other assets, industrial, I was telling Dana earlier, my favorite is industrial. I like industrial and manufacturing. It's the beginning of all business. Without them, we have nothing. So I like them, and I like to invest in as many as possible. And self-storage. Got some of those coming up too.
Yeah.
So
That's great. It's great that you have all those different asset classes. It's really good that part of the diversification as well for people, because there is not just multifamily. It just happened to become very popular with syndicators. And it's often hard to, unless you are at a certain level in commercial real estate, to have access to good industrial is really challenging, because usually that goes to family offices and institutions. So for the rest of us to get into industrial, triple net lease type of stuff is more challenging. Same with mobile homes, because those kind of get swept up by institutional investors. So it's good to know that you have all of that available. So I hope that everybody will look you up. We can connect with you on the QR code. You are one of our esteemed supporting members in Women of Wealth, and we really appreciate you and your time, and just everything, all of your support for WOW and sharing your experience. And if there's any final words that you want to say, we've gone over time, so thank you for being so generous with your time as well.
You're very welcome. Well, it was fun, and it was a little I don't know. I wish there was something I could do, but I can help in the future, not in the past, unfortunately. And we all have lessons that we learn. Those lessons, we just don't want to repeat some of those lessons, and pull up your bootstraps and move forward. It's all you really could do. And we'll come out of it. Just don't know how we're going to come out of it, but we will come out of it and be better off for the people we are.
I agree.
So thank you very much.
Yes, thank you so much, Peggy. We appreciate you.
Thank
and I
you,
will send
Peggy.
all of your information out with the recording next week.
And if you have any questions, just feel free to reach out to me. I'm happy to do that.
Awesome. Thank you.
Thank
Thanks.
you.
Bye.